हेलो गाइस, आवाज आ रही है मेरी? हेलो गाइस, एम आई ऑडिबल? हेलो एवरीवन। सर हम लाइव है?
सर।
हाँ हाँ सर, चलो चलिए। हेलो गाइस, गुड इवनिंग एवरीवन। ये हमारा सेशन 2 है, अगर आपको याद रहेगा तो। सेशन 1 में हमने अच्छे खासी चीज़ों को कवर कर ली थी। सेशन नंबर 2 स्टार्ट कर लेते हैं। सेशन नंबर 2 वी विल बिगिन विद और चैप्टर 1 ओनली। सी, before starting session number 2, we have covered our chapter number 2 and chapter number 3 100%. If you will see the weightage as well, it will be around 9.5 and 6.5. So around we have covered 16 marks. So now we are jumping to our first chapter, which is shares and debentures. In case of shares and debentures also, we have covered around 20 to 30%, and we will cover the remaining 70%. And after that, we will jump to accounting standards. So these are the major things which we should target to cover today. Okay. So till right issue we have covered everything. In case of notes and all, I will upload the same in Google Drive, and I will try to share the what I can say. I will share the link below the videos. Chalo. So in case of bonus shares and so on, see, in case of your chapter 1, basically your chapter 1 is bifurcated into many parts. First is relating to equity shares, the issue of equity shares, forfeiture of equity shares, reissue of equity shares. And then comes bonus shares, then comes preference shares issue as well as redemption. The same is for debentures, and after debentures, we will have underwriters. So in case of bonuses, see, first I will make you understand what is the logic of bonus shares, why bonus shares are issued. We will jump on that logic, and then we will cover the remaining part. See, if I will say ki, see, I have rupees 2000. I have rupees 2000. And I have 100 rupees note of 20 100 rupees notes. So the value of both is 2000 only. The value of both is 2000 only. But the denomination in the first case is 2000, and my second case is 100 into 20. So the value in both the cases is 2000 only. But when you go outside the market, the 100 rupees note or the 100 rupees denomination is more acceptable than 2000 rupees. I cannot go to the bus driver and say, sir, take 2000 rupees and give me the change. It is very difficult for them. But 100 rupees note is acceptable of most of the vendors and all. In the same way, see, I have a company. I've sold the share for rupees 10. I've sold the share for rupees 10. After 5 years, after 8 years, my company is performing extremely well. The value or the market price of the share is now, say, 1500. After 10 years, so the market price of the share is 1500. Now I'm facing a problem. Sir, what problem you are facing? See, it is a simple economics ka funda. Higher the price, lower the demand. But sir, my quality is best. Yes, I know, but still, this economic funda will affect me. So what I will do, instead of selling one share, the market value of which is 1500, I will give one share for free. So first, my value of one share is 1500. Now I'm giving them one share free. Very good, sir. So for this share, you will get one share free. If the share is free, the cost is 0. Agree? Now the total value of shares is 1500. But instead of one, these are 2 shares. So effectively, I've reduced my one share price to 750. This is the major reason behind issue of bonus shares. I will take one more example if you are comfortable. See, when you go in DMart, so example of DMart one, yeah, they are saying that Nikhil, 2 pence, Nikhil, there are 2 pence. Cost of one pen is rupees 100 and cost of second pen is 0 because it is buy one, get one free. What you will say, sir, I have bought one pen for 100 rupees and bought the second pen for 0. No. What you will say is, sir, we have bought 2 pens for 100 rupees. Effectively, each pen costing me 50 rupees. Same is the logic behind bonus shares. Bonus shares are given for free. The major reason is to decrease. See, it's just like instead of 2000 rupees denomination, I'm breaking that 2000 into 4, 500, 500, 500, 500 denominations. This is the major reason behind bonus issue. So we should start now. So bonus shares, the technical terms we will also read it. Capitalization of the profit is the process of converting profit or reserve into paid up capital. Bonus shares share is a free share issued without any consideration. See, do you think anything is free? No, sir. You have bought one pen. That was the reason we have provided you second pen for free. Bonus shares is a free share issued without any consideration to the existing shareholders in the ratio of number of shares held by that shareholder. Issue of bonus shares decreases the reserves and surplus and increases the issued capital but does not bring any change in cash flow or net worth. Simple words, if I will say this in simple words, what we will do, see, you want to give free shares, na? Nikhil, you want to give free shares? Yes, sir, I want to give free shares. So this is your capital, this is your reserves and surplus. So the amount in reserves and surplus will be transferred to capital. Means your reserves and surplus account will be debited and your capital account should be credited, because we want to decrease, we want to transfer our reserves and surplus to capital. So see the sequence of usage. Please remember the sequence. Normally this sequence is followed in the institute. First is capital reserve, second is CRR, third one is securities premium, fourth is general reserve, and fifth is profit and loss account. Normally you will find only this kinds of reserves. So the first one to be used is capital reserve, followed by capital redemption reserve. Third is securities premium, fourth is general reserve, and the last one is profit and loss account. Two things to be remembered. Not to be used if the profits are not realized in case. Not to be used in case of revaluation reserve. So if the question comes, Nikhil, I have a capital reserve of 100, CRR of 200, securities premium of 300, 40 not realized, and followed by general reserve 400, and followed by profit and loss account, which is 500. So follow this sequence only. First will be capital reserve, and after that we will use capital redemption reserve, then it will be securities premium, then it will be general reserve, last will be profit and loss account. And the wordings are 40 is not realized in cash. And I will also add one more thing. Revaluation reserve is 600. So my sequence of usage will be First will be capital reserve, then will be CRR, followed by a securities premium, then general reserve, then profit and loss account. Revaluation reserve should not be used, should not be used. And in case of securities premium, see, out of this 300, 40 is not realized in cash. So we can only use 240, 260, my bad. 300 minus 40 will be 260. So we are able to use only 260 in case of securities premium. So first we will use 100, then 200, then 260, then 400, then 500 ultimately. So other terms and conditions. It should be authorized by articles of association. See, you should remember these few points when authorization of articles is required. This can be in true or false as well as in some MCQs as well. It has to be recommended by the board. It has not defaulted in payment of any interest or principal amount. It has not defaulted in respect of any payment of statutory dues of employees such as contribution, provident fund, etc. If there are partly paid up shares, the partly paid up shares, if any outstanding on the data are made fully paid. So we should not issue bonus to partly paid up shares. We should convert them into fully paid up shares. Restriction all will not be asked by you. See, different ways to capitalize the profit. Convert partly paid up shares into fully paid up shares by using free reserve, which is normally not used. Follow this sequence, which is the most important sequence in our case. So what will be the entry? Respective reserve account debit to share capital account. So the entry for this will be, see, if I'm using capital reserve, my entry will be capital reserve account debit to share capital account. So we should scroll now. See, all these sums are, see, illustration 5, 15, illustration 16, and so on. You can refer your module and practice the same. Issue of sweat equity shares. So what do you mean by sweat equity shares or ESOPs? What do you mean by ESOPs and why they are used and their terms and conditions? See, ESOPs are given to the employees. ESOPs are given to employees. So why you are giving your shares to your employees? See, in case I will take the example of in IT companies. Infosys is saying ki, Mr. X, come here. How much Tata is giving you salary? Sir, I am receiving 1 lakh rupees salary. Infosys is saying ki, I will give you 1 lakh 20. Resignation from TCS. I am going to join Infosys. After 2 months, Wipro approaches Mr. X and says, Mr. X, how much salary you are receiving? 1 lakh 20. Wipro will say, I will provide you 1 lakh 50. Join my company. Oh. Sir, resignation, sir. They are providing me 1 lakh 50. Infosys will say, Mr. X, wait. I will give you 1 lakh 60. Don't go. Okay, take it, sir. Okay. As you say. After again 2 months, Tech Mahindra has approached Mr. X. Mr. X, how much you are receiving? 1 lakh 60. I will pay you 2 lakh rupees. Hey, this is not fair now, Mr. X. Mr. X will say, see, he is paying me more. I will work there only. To avoid this, they have given an option. Mr. X, do you know the share? Do you know my share? Yes. Very good. Do you know what is value of my share? Yes, sir, it is 500 rupees. I will give you this 500 rupees ka share only for you for 40 rupees. 500 rupees wala share only for 40 rupees to me. Yes. But there is a small condition. you should work with me for 1 year. If you will work with me for an year, I will provide you 500 rupees wala share to you for only 40. This was the main reason behind ESOPs. So what do you mean by ESOPs? Sir, ESOPs are shares given to employees for availing their services and for their retention as well. So only in case of ESOPs, shares can be issued at discount. See, I will say it again. Shares can be issued at premium. Yes. Shares can be issued at face value. Yes. Can shares be issued at discount? Shares are prohibited to be issued at discount. But there is a small exception. In case of ESOPs, shares can be issued at discount. So, what are the terms and conditions? The issue is authorized by special resolution. The resolution specifies the number and the current market price and to whom these shares are allotted. What will be the accounting entry? Or see, if you are receiving relating to a particular asset, you should debit that particular asset. If you are not receiving to that particular asset, but you are giving it to employees for free of cost or for a very negligible value, the remaining amount should be debited to profit and loss account. So for say you are giving 500 rupees wala share to Mr. X only for rupees 40, the remaining 460 should be debited to your profit and loss account. So we should move now. Now this is buyback of shares. See, I know we are covering majority of the sum in question in what I can say in case of chapter 1, majority content will be in theory only. And since our pattern is now MCQ1, this is more required than the practical sums. So chalo, in case of buybacks, what are the terms and conditions for buyback? This is the most important thing. Please remember this thing. First condition, as per section 67, first condition is no company, whether public or private, shall buy its own shares. However, the right of the company to redeem the preference shares shall not be affected. Means you can redeem your preference shares, but you are not allowed to buy your own shares, following other exceptions and rules. General rule. No public company shall give financial assistance for purchase its own shares or its holding shares. Means, see, A Limited should not purchase its own shares. A Limited is saying, well, B Limited, come here. You are my subsidiary, na? See, I am not allowed to buy my own shares. I will give you money. You buy my own shares. You buy my shares. That is also not allowed because he is your subsidiary. It is your subsidiary as well as you are giving him financial assistance. No public company shall give financial assistance for the purchase of its own shares or its holding shares. The restrictions apply to every kind of financial assistance, whether it is direct or indirect. Exceptions to the rule. Lending of money by the banking in an ordinary course of business is allowed. Means, I am a bank. I'm a non-banking financial institution here. My main purpose is to lend money. So if I'm giving him a loan, and for what purpose he is using is none of my business. So in that case, this is the exception. The second exception is, I will go this and I will go this well apart. If the loan is given by the company to the person in the employment of the company. He is my employee and I have to give him loan is nothing but an advance salary of 1 or 2 months. And what he wants to do, it's none of my business. So that is also allowed. Exemption is given to private companies. Exemption is given to private company. Section shall not apply if all the terms and conditions are satisfied. Section 67 shall not apply if all the terms and conditions are satisfied. It is a private company. No body corporated has invested any shares has invested any money in share capital of such private company. No investment from body corporates. The borrowing of cash of private company from bank or financial institution is less than twice its paid up capital or 50 crore, whichever is low. Your borrowing is less than 2 times of your share capital. If my share capital is 100 crores, 100 crores into 2, your maximum borrowing should be 200 crores or 50 crores, whichever is less, is your limit. Is your limit. Such a private company is not in default in repayment of any loan. So I will re-explain this point. See, I have a, I've taken a loan of, I've taken a loan of 40 crores. I've taken a loan of 40 crores. Okay. My share capital is 70 crores. So the limit for this should be twice its paid up capital. So 70 into 2 is 140 crores or 50 crore, whichever is less, or 50 crore, whichever is less. So my maximum limit of borrowing is 50 crores. So my loan, the loan taken by me is less than 50 crores, means I'm eligible. Means section 67 is not applicable to me. Power of company to purchase its own securities. Section 68. Yeah, section 67 prohibits. Section 68 allows you to buy back shares. Your own shares, yes. Sources for your buyback. Free reserves. My bad, huh? Sorry. Sources for your buyback are free reserves, securities premium, or the proceeds of issue of any shares or other specific securities. Means either you can use your free reserves or securities premium, or you can issue your shares to buy back some other type of shares. We have already discussed there can be different types of shares as well. Provided that no buyback of any kind of shares or other specific security shall be made out of the proceeds of the earlier issue of same kind of shares or same kind of other specific securities. See, shares type A, shares type B. So to buy back share types A, you can issue share type B. But to buy back share type A, you should not issue against share type A. Conditions for buyback should be authorization is required. Resolution for buyback and limit. Resolution for buyback and limit. This is the most important thing again. So buyback is authorized by board. If buyback is only authorized by board, not exceeding 10% of aggregate paid up capital plus free reserve. Buyback is authorized by board as well as with the help of special resolution, you can increase your limit to 25%, not exceeding 25% of paid up capital plus free reserves. So if we have received only board resolution, the limit is up to 10%. If we have passed special resolution, the limit has been increased to 25%. 25% of what? Paid up capital and free reserves. In any financial year, buyback should not be more than 25% of total paid up equity capital in that financial year. This is the third condition. This is first and second condition, either A or B, either one or two. Apart from this two, the third condition is in any financial year, buyback should not exceed 25% of its total paid up equity capital in that financial year. Notice of general meeting in which special resolution is passed shall be accompanied by an explanatory statement stating all the material facts and so on. Debt to equity ratio. Debt to equity ratio. Simple words means your total loan divided by your share capital. The ratio should not be more than 2. If my loan is 100 and my equity share capital is 50, answer is 2. Up to 2 allowed. So if my loan is 200 and my equity is 50, 200 divided by 50 comes to 4. Buyback is not allowed then. Okay. Buyback can be done only of fully paid up shares. Time limit minimum 15 days, maximum 30 days. If all members agrees, we can reduce the period by less than 15 days. Completion of buyback within 1 year from passing the resolution. Board resolution oblique special resolution. Buyback from whom? From the existing shareholders, from the open market, purchase the securities issued to the employees of the company. Declaration of the solvency. The company shall file with the registrar a declaration of solvency stating that it will not be rendered insolvent within next 1 year. See, these are few terms and conditions which we should remember. And I can say we will get at least 2 marks MCQs from this section. Extinction of shares. Within 7 days, you should destroy the shares. Prohibition on further buyback. Once you have buyback, there is a prohibition of 1 year from the closure of the preceding offer of buyback. Agreed? Further prohibitions are shall not further issue within the next 6 months. The company shall not further issue same kind of securities within the next 6 months except by way of see, after buyback, you should not issue same kind of securities for 6 months. Following other exceptions. So we can issue bonus shares. Sir, we can issue bonus shares. Issue of shares in discharge of subsequent obligations such as conversion of warrants, conversion of stock option scheme, ESOPs, and so on. Registration of shares bought back. Registration of shares bought back. You should maintain the registers. This is not much important. Other compliances, in case of listed companies, you should listen to SEBI. And if you are an unlisted company, you should listen to the central government. So what is section 69? Transfer of certain sum to capital redemption reserve. CR creation is mandatory. Yes. If buyback is made out of free reserves, securities premium, or out of free issue of shares. See, these are the 3 sources: free reserve, securities premium, out of the fresh issue of securities. 1, 2, 3. These 3 are covered here. If your buyback is made out of free reserves of securities, CRR creation is mandatory. If a buyback is created out of fresh issue, CRR creation is not mandatory. Sir, how to create CRR? How to create CRR? So, see, you should use free reserve to create CRR. Means, sir, I have a general reserve of 100 rupees and I want to create CRR of 30 rupees. The entry which I should pass is CRR, general reserve account debit 30 to CRR 30. I am debiting general reserve by 30 and I am crediting a capital redemption reserve by 30 rupees. This is the way you can create CRR. Amount of CRR. Amount should be equal to the nominal value, which is nothing but face value of shares bought back. And if the shares are bought back using free reserves or securities premium. Utilization of CRR. CRR should be utilized only for issue of bonus shares. CRR can be utilized only for issue of bonus shares. This is also important. Chali. Yeah, I have written the same thing here. Same prohibitions which we have read earlier. Some SEBI guidelines and escrow account advantages of buyback, which they will not ask in your MCQs questions now. Now we are jumping to preference shares. Redemption of preference shares. A company limited by shares, if so authorized by its articles. May issue preference shares which at the option of the company are liable to be redeemable within a period normally not exceeding 20 years from the date of issue. See, preference shares are always redeemable. Irredeemable preference shares are prohibited by Companies Act. So what is the tenure? What is the maximum tenure? It is 20 years. That we will find some exceptions as well, but it is 20 years. Generally, it is 20 years. No shares shall be redeemed except out of profits of the company, which will otherwise be available for dividend, or out of proceeds of fresh issue made for the purpose of redemption. Means your source of redemption. It will be out of the profits of the company or out of the proceeds of free issue of shares made for the purpose of redemption. No such shares shall be redeemed unless they are fully paid up. Same conditions which we have seen in buyback. See, in case such class of companies as may be prescribed and whose financial statement are audited under section 133, there is a restriction of securities premium, which we have read. So, securities premium can be used for 5 purposes. First is bonus, buyback, preliminary expenses, on issue, on writing of any expenses relating to issue of shares and debentures, on use on redemption of preference shares and debentures, or premium paid on redemption of preference shares and debentures. But if you're section 133 company, it could be used only for 3 things: for buyback, for bonus, for any expenses, issue expenses relating to shares only, and equity shares more specifically. Agreed? So mode of redemptions are the proceeds of fresh issue of shares, capitalization of undistributed profits, or by A and by B both. One of the method for redemption of preference shares is to be used for the purpose of the fresh issue of shares. A company can issue new shares. They can be either equity or preferences, and the proceeds of such new shares can be used for redemption of preferences. The proceeds from the issue of debentures cannot be utilized for these purposes. See, there is a small distinction between shares and debentures. Acknowledge the ownership of the company. Acknowledge the creditors of the company. Status, owner. Status, not a member but a creditor. Return is in the form of dividend. Return is in the form of interest. Rate of return is depends from year to year. It is normally fixed. Accounting treatment, dividend is considered as appropriation of profit. This is considered as charged against profit. Voting rights, shareholders has voting rights. Debenture holders cannot have any voting rights. So we are jumping to our next part, which is issue of debentures. So section 71. So after completing this lesson, we will run through a bit more summarized one, what we have covered in this chapter. I know this is one of the biggest chapter. Section 71, issue of convertible debentures. Any company may issue convertible debentures with the option to convert such debentures into shares either wholly or partly at any time of redemption, provided that the issue of debentures with the option to convert such debentures into share wholly or partly shall be approved by special resolution passed at the general meeting. They will not receive any voting rights. DRR, we will refer this below. Secured debentures, maximum 10 years. However, in the following case, maximum period is 30 years. Normally, it will be maximum period of debentures is 10 years, but in the following cases, we can issue for 30 years as well. So preference shares was 20 years. In case of debentures, it is 10 years. And the maximum period in the following 4 cases will be 30 years. What are the following 4 cases? The company engaged in setting up infrastructure projects, infrastructure financial company, infrastructure debt funding non-banking financial corporation company permitted by law. See, the first one is infrastructure projects. The second one is infrastructure financing company. The third one is infrastructure debt fund non-banking financing company. Infrastructure company, infrastructure. And the fourth one is permitted by law, which has maybe specified by any law. So, appointment of trustee, debenture trustee. Appointment of one or more debenture trustees mandatory if the company issues a prospectus or the company makes an offer or invitation to the public or the company makes an offer to the members exceeding 500 members. This is the most important one. Please remember this thing. When debenture trustee is required, while if you have issued the prospectus, means you are asking money from public at large. Invitation to the public when the members are more than 500. Duties of the debentures trustee, liability, and so on is not required. Huh? This point is important. Liabilities of debenture trustees. The provision for indemnifying the trustee shall be void. However, exemption may be provided for 3/4 in the value if 3/4 of the debenture value is agreed. If debenture trustee has done anything wrong and 3/4 in value of debenture holders agree that we should forgive him, then it is allowed. Otherwise, you cannot forgive them. Insufficient amount and failing to redemption. This won't be asked in your exam. Debenture trustees and all. Discount on issue of debentures. We will jump to discount on issue of debentures now. When debentures are issued at discount, it is prudent to write off the discount during the life of the tenure. See, value of debenture, the nominal value is 100, but I've issued the debentures at a discount of rupees 20, and I've received rupees 80. The tenure of debentures is 5 years. So that is discount of rupees 20. This discount of rupees 20 should be written off in 5 annual equal installments. So 20 divided by 5 years. Every year, rupees 4 should be debited to your profit and loss account. Simple. There will be more sums where the period of redemption is annually. When debentures are issued as collateral securities, you can issue debentures as your collateral securities. So you have following two options. The first one is not to make any entry in the books, but you will say, see, if I'm not able to pay you, 1 lakh rupees, I will issue debentures of 50,000, 80,000, 2 lakh, 3 lakh, so on. And the second thing is to pass that entry as well. Sometimes issue of debentures as collateral security is recorded by making journal entries as follows. Debenture suspense account debit to debenture account. Appearing on the asset side, appearing on the liability side. See, debenture account will be debited, yes. But which debenture account will be credited, but which account should be debited now then? See, I have told Mr. X, I have communicated with Mr. X. Mr. X, if I'm unable to pay you, following amount, I will issue debentures of 1 lakh. If I'm unable to pay you, then I will issue debentures of 1 lakh rupees. So these are considered as your collateral security. The treatment and accounts will be the first method, which is the most sensible one. We will disclose this as a note. The second method, so you should pass the entries. We have not yet issued the debentures. If we make any default, then we are liable to issue debentures. But in case of second method, they are saying, Nikhil, you should pass an entry. Should credit debentures account with 1 lakh rupees, and you should debit debentures suspense account with 1 lakh rupees. The entries: debenture suspense account debit to debenture holder account. One will be shown in your liability side, the other one will be reflected in your asset side. When the loan is paid, the entry will be reversed. Redemption of debentures. Redemption of debentures. After the fixed number of years, at any time after a certain number of years have left since their issue, or by giving a specific notice, or by annual drawing. These are the ways. DRR is more important. No? DRR, creation of DRR is more important. DRR is nothing but debenture redemption reserve. We have also seen this term in our chapter 2, schedule 3. Sir, requirement and creation of DRR is important. The first thing is, this is listed should always be public company. Huh? It should not be a private company. Listed companies are always public companies. Creation and requirement of DRR. If you are a listed company, and you are AIFI and banking company, DRR is not required. If you are a listed company and you are NBFC and HFC, then also DRR is not required. If you are a listed company and other than the other two companies, DRR is still not required. But if you are an unlisted company, we have bifurcated into private and public. If you are an unlisted private company or unlisted public company, which is AIFI or banking company, still DRR is not required in your case. If you are an unlisted public company, DRR is required in case of NBFC and housing financial corporations. If you are an unlisted public or private company, other than the above two companies, DRR is required. Appropriation of DRR is to be made at any time before redemption. You have to pass a single entry DRR account, general reserve account debit to DRR account. You have to create DRR account, and after repayment, you will pass the reverse entry DRR account debit to general reserve account. Minimum debenture redemption reserve investment amount. Creation of DRR investment reserve. 30th of April of the year of sale. Amount is 15% of the debentures maturing. These are the two amounts which should be remembered, date and amount, since this can be an MCQ question. SEBI requirements will not be asked in your case, huh? So please don't remember this part. I don't think so they will ask such minute details in MCQs. So creation of DRR, profit and loss account to debenture redemption reserve account. Agreed? Closure of DRR account, debenture redemption reserve account debit to general reserve account. The reversal of the first one. So we should go now then. We should jump to underwriting of shares and debentures. We will solve one sum as well in this case. Underwriting is an agreement with or without conditions to subscribe to the securities of the body corporate when the existing shareholders of the corporate or the public does not subscribe the securities offered by them. As per the Companies Act, if minimum 90% of the total issued capital is not subscribed, the amount should be refunded. Following are the points to be considered by the lead manager while appointing underwriter. Ensure that the underwriters do not overexpose them. Overall exposure all be assessed carefully. Underwriters' ability to discharge their underwriting obligation and so on. The important points will be in respect of every underwriting issue. The lead merchant manager shall undertake a minimum underwriting obligation of 5% of the total underwriting or 25 lakhs, whichever is less. The outstanding underwriting commitment of a merchant banker should not be more than 20 times of his net worth at any given point of time. Sub underwriting is not an issue. Underwriter's commission. Maximum underwriter's commission is 5% of issue price in case of shares, 2.5% of issue price in case of debentures. Commission is paid on the shares underwritten by him and not on the shares purchased by him. 2 points should be remembered. Authorized by the AOA, which is not an issue. And the second point is, in case of shares, it is 5%. In case of debentures, it is 2.5%. 5% of what? 5% of not face value. 5% of issue price. And commission is calculated on the number of shares underwritten by him. Type of underwriting: 100% underwriting. See, and partial underwriting. 100% means I will take 100% of your shares. Partial underwriting means I will take 60%, 70%, and 80% of your shares. Then it is further bifurcated without firm underwriting, with firm underwriting. With firm underwriting means I will purchase minimum 1,000 shares. I will purchase minimum 1,000 shares. Yes, definitely. Minimum this much amount of shares I will purchase. That is known as firm underwriting. We will read the definitions as well. Don't worry. Full underwriting, 100% is taken. Partial underwriting, 75 or 85 or 60%. Take an example, other than 100%. Conditional underwriting. Under this type of agreement, the underwriter agrees to take up agreed proportion of shares not taken by the public. If the shares are fully subscribed by the public, the underwriters does not take up any shares. Firm underwriter. Under this type of agreement, underwriter agrees to take a specific number of shares irrespective of the subscription. Marked application and unmarked application. We will understand these two things with the help of an example. We will what I can say. We will solve question number 38 to understand the underwriters working and all. So question number 38. Unlimited issued 80,000 equity shares which were underwritten as follows: by Mr. A 48, by Mr. B 20, by Mr. C 12. So 48 plus 20 plus 12 comes to 80,000 only. 48 plus 12 comes to 60, 60 plus 20 comes to 80,000 only. The above mentioned underwriters made application for firm underwriting as follows. So we will start with question number 38. Unlimited issued 80,000 equity shares which were underwritten by ABC in the ratio of 48,000, 48, 20 and 12. So chalo, particulars. A, Mr. B and Mr. C. The total liability of them is 48,000 and 20,000 and the last one is 12,000 and the total is 80,000. This is their respective total liability. Out of the total liability, we have received a subscription for 40,000 shares. We have received an application of subscription for 40,000 shares. Okay. So out of 80,000 shares, the public has applied for 40,000 shares. Very good. But out of this 40,000 shares, 8,000 of the investors were brought by, or the shareholders were brought by Mr. A, 10,000 shareholders were brought by Mr. B, and 4,000 shareholders were brought by Mr. C respectively. So out of this 40,000, 8,000, 10,000 and 4,000 are brought by Mr. ABC. Okay, sir. And the remaining was due to company's reputation. So we will bifurcate this into two parts. One is unmarked and one is marked one. So we will bifurcate this 40,000 into two parts. One is marked one. Marked means with the shareholders or the investors brought by the respective underwriter, and then the unmarked one. Unmarked one now. The marked one in case of A is 8,000. In case of B is 10,000. In case of C is 4,000. So 8 plus 10 comes to 18 plus 4 comes to 22. So the remaining unmarked applications were 22 minus 40 comes to 18,000. So the applications are marked one is 8, 10, 4. Unmarked are 18,000. So we will subtract this 40,000, which is further bifurcated into two parts. One is marked one is unmarked one. In case of marked one, and in case of unmarked one. In case of marked one, marked application means the investor which is brought by A. Mr. A has brought 8,000. B has 10,000 and Mr. C has brought 4,000. Again, unmarked application. Unmarked application will be unmarked application will be bifurcated in the ratio of 48 is to 20 is to 12, which is their respective ratio, which is 48 is to 20 is to 12. Agreed? So my unmarked application is, your unmarked application is 18,000. Out of 40,000, 22 is marked one, the remaining is unmarked one. This 18,000 will be distributed between A, B, C in their liability ratio, which is 48 multiplied, 18,000 multiplied by 48 divided by 80. 18,000 multiplied by 20 divided by 48. 18,000 multiplied by 12 divided by 48, which is 10, 800, 7, 400, 5,400 respectively. So the net liability, is 48 subtracted by 10,000, 8,000 and 10,200. So 29,200, 2,500, 3,500 respectively. Out of the above application, I should be 40,000. 42 divided by 80 divided by 80. This should be divided by 80. This should also be divided by 80. So the remaining one is 40,000. So we have distributed the marked application as well as the unmarked application. The net liabilities 29,200, 5,000 application as well. They had said ki Nikhil, we will purchase minimum this much amount, which is the firm underwriting. Firm underwriting is the amount which they will minimum buy. So in case of A, it is 6,400. In case of B, it is 8,000 rupees. And in case of C, it is 2,400. So this is the minimum number of shares which will be bought by ABC. The total of which is 16,800. So the net liability will be 29,200 minus 2,400, which comes to 22,800, 2,500 negative, 2,900. Okay. See, there can be either zero liability, which is no liability, or there can be a liability. There cannot be a negative sign. Huh? There cannot be a negative sign. So we will distribute this excess amount. Excess amount of B will be distributed between A and C in their ratio. In their which ratio? In their liability ratio. Excess amount of Mr. B is distributed between Mr. A and Mr. C. In which ratio? In their liability ratio. Mr. A's liability ratio is 48, and in case of Mr. C, it is 12. So this 2,500 will be redistributed between A and B in 48:12 ratio. Means 2,500 multiplied by 48 divided by 60. 2,500 multiplied by 12 divided by 60, which is 2,000 and 2,500. So the net liability in case of Mr. A is 20,800. In case of Mr. B is 0. In case of Mr. C is 2,400. So the number of shares which will be bought by Mr. A, Mr. B, and Mr. C will be number of shares to be bought by underwriters will be in case of Mr. A, Mr. B, and Mr. C. Firm underwriting and net liability. Firm underwriting in case of Mr. A was 6,400, in case of Mr. B was 8,000, and in case of Mr. C was 2,400. And the other liability, or the liability which we have, the net liability which we have calculated in our first case. In case of Mr. A is 20,800, in case of Mr. B is 0, and in case of Mr. C is 2,400. So the total liability of the three underwriters is Mr. A is 27,500, Mr. B is 8,000, in case of Mr. C is 4,800. Respectively. So hopefully we are comfortable with our working and with our sums. See, in case of problem, in case of underwriters, I have solved the sum. The main reason is ki it is difficult to students many times to understand ki, sir, how should we calculate the underwriters calculation and so on. So you should subtract unmarked, marked, and firms underwriting in a single go. The negative balance should be distributed between the remaining underwriters in their liability ratio. We will find the net liability. So we should calculate the total liability. Total liability will be your net liability plus the firm underwriting. So we should summarize this sum as well. So the first one is refund of application money. it should be within 15 days. If you have not refunded within 50 days, the officers in default should pay 15% interest. Calls should contain minimum 5% of the application money. And we have seen some accounting entries. In case of securities premium, the usage of securities premium is very important. The securities premium can be used in 5 cases. First is bonus, second is buyback, third is preliminary expenses, writing off of preliminary expenses, expenses relating to issue of shares and debentures, premium paid in case of redemption of debentures and preference shares. The following is the exception. If the company is Section 133 company, securities premium can be used only in 3 cases. The first one is buyback. The second one is bonus. The third one is expenses on issue of equity shares. Okay. Provision on issue of shares at discount. Shares can be issued at face value. Shares can be issued at securities at premium, but shares cannot be issued at discount. The only exception is ESOP, employee stock option scheme. In case of calls in arrears and calls in advances, following things should be remembered. Maximum interest rate in case of calls is 9%, in case of calls and advances is 12%. So, forfeiture of shares, we have understood the entry. Ratio of shares was good one. In case of right shares, in case of right shares, the person, the existing shareholder should be asked first. The minimum period is 15 days, the maximum period is 30 days. If they have not asked, they can be renounced. We have also understood the theoretical value. How should we calculate the theoretical value? First, you should understand the market value of shares. In our current case, it was 5. So 5 into 42. Then we should understand for every 5 shares, the number of shares received over 2. So 2 into amount paid, which is 11, which is 2 into 22 comes to 2 into 11 comes to 22. We should add both the amounts and we find the average price. Average should be subtracted with the market price and we will get the theoretical price. And now we are jumping to bonus shares. In case of bonus shares, the sequence of using of reserve is most important. First one is capital reserve, second one is CRR, which is capital redemption reserve, third one is securities premium, fourth one is general reserve, fifth one is profit and loss account. See, the module follows this sequence, so this sequence should be followed. And the second thing is revaluation reserve should not be used. Any reserve which is not realized in cash should not be used. Other points are easy. It should be authorized by articles. That is the most important one. Capitalization is time. In case of ESOPs, in case of issue of ESOPs, special resolution is required. Profit and loss account should be debited in case of ESOPs. In case of buyback of shares, companies are prohibited to buy back its own shares. The only thing is the company can neither directly neither indirectly give financial assistance for his own buyback. The exceptions are if you are a banking company, businesses of banking, or if you are a company who is providing loans to its employees. Exemption was to a private company. If you are a private company, there is no investment by an body corporate. The loan taken by you is less than twice of your share capital or 50 crores, whichever is less. Repayment of any loan. Power of company purchases own share under section 68. Please remember this section 68. Resource free securities premium and by issue of other securities. Conditions is authorized by articles. Limit was if you have taken board with the help of board resolution, the limit is maximum 10%. If special resolution is passed, the limit is 25%. 10% and 25% of what? Paid up capital plus free reserve. But there is third limit as well. And what is that third limit, sir? It should not exceed 25% of the total paid up equity share capital in any particular financial year. Debt to equity ratio should not be more than 2% after buyback. Shares should be fully paid up shares. Minimum period is 15 days, maximum period is 30 days. Time limit for buyback is 1 year from the date of resolution. Buyback should be from the existing shareholders in the proportion from the employees from the existing market. Declaration of insolvency that you should not be, the company should insolvency that that it will not be insolvent for the next 1 year. Prohibition on further buyback for 6 months. Only the exceptions are in case of bonus or by satisfying any liability or converting any debentures into shares. The third thing is creation of CRR. If buyback is if buyback is made with the help of free reserves or securities premium, CRR is mandatory. If buyback is done with the help of equity share capital, CRR creation is not mandatory. CRR can be used only for issue of bonus shares. चलो ये हो गया. Yes, preferences maximum 20 years. Shares and debentures. In case of debentures, maximum is 10 years, but in the policy it is 30 years. Tenure will be 30 years. One is company engaged in setting up infrastructure project, infrastructure financial companies, infrastructure ventures fund, non-banking financial companies. And the fourth one is permitted by law. Appointment of trustee is important. In which case, in case of prospectus, in case of public issue invitation, and if the members are more than 500. So SEBI rules are over. Discount or debentures can be issued at discount. That discount should be distributed proportionate to the tenure of the debentures. The debentures can be issued as a collateral security. First method is to disclose it, to disclose as a note. The second method is to pass a journal entry. Journal entry will be debenture suspense account debit to debenture holder account. DRR creation is mandatory. In case of AIFI and banking companies, DRR is not required. In case of NBFC and HFC, DRR is not required if the company is a listed company. If a company is an unlisted company, DRR is required only in case of public companies. In case of any other companies, if you are an unlisted company, DRR creation is required, whether you are public or private. We should jump now to in case of underwriters of is the voice clear now? Am I audible now? Am I audible now? Hello, am I audible now? Is it still cracking? Is it clear now?
Yes, sir, it is clear now.
Okay, sir. Sure. So, in case of underwriter's commission, it should be authorized. It should be authorized by articles of association. The maximum commission is 5%, and in case of issue of shares, and 2.5% in case of debentures. And 5 and 2.5 should be calculated on the issue price. Uh, the third thing is underwriting should be bifurcated into full or partial underwriting. They should be further bifurcated into without firms underwriting, with firms underwriting. The terms which are used full underwriting means 100% coverage is done. Partial underwriting means 80% or 90% is done. Conditional underwriting means if the shareholders or if the members has not applied or if the investors has not purchased the shares, then I will purchase the shares. In case of firm underwriting means I will purchase minimum 5,000, 8,000 or 10,000 shares. What is marked and unmarked application? Any investor which is uh, which has invested in the company because of a particular underwriter should be termed as a marked application. We will read the technical term as well. And in case of unmarked application, they have came because of the reputation of the company. In case of marked application, are those applications which bear the stamp of underwriter. It is issued if the issue is not fully subscribed. Marked application shall be applied in reduction of underwriter's liability, which we have calculated below. In case of unmarked application, does not bear underwriter's stamp. Okay, sir. So we have covered our first chapter as well. These were our three important chapters which are covered. So these three chapters are covered in our case. So you will see chapter 1 with 9.5 marks done. Financial statements done. Cash flow done. And same goes for the objectives as well. They will be covered in our chapter 1 to 3 because we have covered our theory sessions as well. So now we will jump to accounting standards. Accounting standards are most important thing, and today we will try to complete all our accounting standards. So first, we will jump to accounting standard 11, accounting for the effect of change in foreign exchange rate. So very short name. Huh? So we should understand few things. Applicable for transactions in foreign currency only. ES 11 is applicable if the transactions are in foreign currency only. Translating the financial statement of foreign branch for inclusion in the financial statement for the reporting enterprise is applicable when the transactions are in foreign currency. When you have a foreign branch and you want to merge or convert that foreign branch into Indian rupee. Okay, so please understand one thing. I am an Indian. For me, any branch which is outside India will be my foreign branch. If the main office in USA, so any branch which is outside USA will be their foreign branch, and it will contain foreign currency. So initially any transaction which is done in foreign currency, any transaction in the foreign currency is recorded in the financial statement of the enterprise, is recorded in the financial statements of the enterprise, normally at the of rate which is treated on the date of transaction. Rate on the date of transaction. So I've purchased the mobile on 5th of April. So on 5th of April, the exchange rate prevailing on that date will be used. But sir, for every day we should watch kya? Ki I have purchased on 5th of April, so the rate is 5 rupees, 50 rupees. I have purchased on 6th of April, the rate is 50.5. I have purchased on 7th of April, the rate is 50.55. Do we have some another alternative? Because I purchase on daily basis, and to watch the rate on daily basis is a bit difficult for me. So, however, falling rates can be used. Normally, you should use the rate on the date of transaction. However, the falling rate can be used. Average rate during the week or month in which the transaction occur if there is no significant fluctuation. Means, sir, on day 1 it was 50, on day 2 it was 50.002, on day 3 it was 50.04, day 5 it was 50.006. So there is no significant fluctuations. So you can take an average rate and use the same for all the transactions. You should not compute each and every rate. Is the slide visible now? Chalo. So applicable to foreign currency, if the transactions are in foreign currency and if the branch is in foreign branch. The rate used at the time of initial recognition, please remember, at the time of initial recognition, the date used should be the rate on the date of transaction. But you can use the average rate if there is no fluctuation. After initial recognition, the exchange difference on reporting date of financial statement should be treated as I think you are only facing this kind of issue. Please rejoin again. Then it will be visible because it is visible in my mobile as well. I have... So we should jump to point number 3. After initial recognition, the exchange difference on the reporting date of financial statement should be treated as after initial recognition on the balance sheet date on the date of settlement. In case of balance sheet date, we will refer to the chart below. In case of settlement, the amount paid versus the amount recognized should be considered as my profit and loss. Means at the time of purchase, assumed I have purchased an iPhone of $1,000. At the date of transaction, the dollar rate was 70 rupees. It was a credit purchase. So I've recorded my iPhone at 70,000. At the time of payment, the dollar rate went up to 72 rupees. So 1,000 into 72, I've paid 72,000. I've purchased for 72. I've recorded for 70,000, but I've paid 72,000. The remaining 2,000 should be debited to profit and loss account. It should be considered as my foreign exchange expenditure. Chalo. After initial recognition, on the balance sheet date, how should it be reflected? This was in case of my expenses. If I've done any kind of expenditure, and in case of balance sheet, so how will it be reflected in my balance sheet? These are bifurcated into 2 parts. One is monetary item, one is non-monetary item. Monetary items, we will take the example of cash, receivables, payable. They will be termed as my monetary items. Non-monetary items are fixed assets, inventories, investments, and so on. So monetary items are reported using the closing rate. Sir, what is closing rate? What is monetary items are covered here. So don't worry. So on each balance sheet date, monetary items will be recorded at closing rate. Example of monetary items are cash, receivables, payables. Non-monetary items are known as fixed assets, inventory, investments. If they are carried at historical cost, exchange rate on the date of transaction. Exchange rate on the date of transaction. If they are carried at revalued amount or fair value, exchange rate on the date of determining the value. So I will bifurcate the thing as well. See, after initial recognition, I should move a bit. I should move a bit below. After initial recognition, they are bifurcated into monetary and non-monetary. Monetary items like receivables, payables should be recorded at closing rate. Closing rate is the rate on balance sheet date. Means if I'm closing my balance sheet on 31st of March 2020, the rate should be considered on that date. Sir, in case of non-monetary items, they are further bifurcated into two parts. One is if they are recorded at historical cost, and the second thing is if they are recorded at fair value or revalued amount. If they are recorded at historical cost, they should be recorded at the rate prevailing on the date of transaction. Means, take an example of iPhone. If iPhone is my fixed asset, and I've purchased my iPhone on 1st of April. 1st of April, no, 1st of May. I purchased my iPhone on 1st of May. The rate was $1 was 70 rupees. $1 was 70 rupees. On 31st of March 2020, the rate is 71 rupees. But my iPhone should be reflected at 70 rupees only. If my iPhone is recorded at historical cost. So $1,000 multiplied by rupees 70. 70 rupees is the rate at the date of transaction. And closing rate is the rate on the date of balance sheet, which we can take in this particular example, we can take this as 71 rupees. If my iPhone is revalued or valued at the fair amount, so $1,000 should be multiplied by the rate which was prevailing when the asset was valued at fair value. See, monetary items report using closing rate. Non-monetary items, if they are valued at historical cost, exchange rate is the date of transaction. If they are valued at fair value, exchange rate is the date on which such fair value is determined. Agreed? So loan taken for purchase of an asset. Any gain or loss should be debited to profit and loss account. We will understand this when we will calculate AS 16. And we will jump on AS 16. The disclosures under accounting standard 11. The amount of exchange difference included in the net profit or loss account should be disclosed separately. There should be a separate item which should say foreign exchange gain / loss, which should be reflected on debit / credit side of the balance of profit and loss account. The amount of exchange difference adjusted in the carrying amount of fixed asset during the accounting period. the amount of exchange difference in respect of forward contracts to be recognized in profit and loss account. And the last one is foreign currency risk management policies. Some terms which we have used. Closing rate is the rate, exchange rate or the spot exchange rate at the end of the reporting period, which was 31st of March 2020. Exchange difference is the difference resulting from the transaction at the given number of units into another currency at the different exchange rate. Simple words में, the exchange rate which you have recorded and the exchange rate at which you are paying, the difference will be termed as an exchange difference normally. Foreign currency is a currency other than the functional currency of the entity. See, in case of India, my functional currency or my main currency will be Indian rupee because and in case of USA, their functional currency will be dollar. Monetary items are unit of currency held and assets and liability to be received or paid in a fixed determinable amount of unit of currencies. Means I have to pay you $1,000 or I will receive $1,000. So $1,000 is fixed, but we cannot say this in case of my inventory. Sir, I can sell him at 40 rupees also, I can sell him at 80 rupees also, I can sell him at 60 rupees also. First thing. Same goes for your assets. So that's why monetary items are cash, payables and receivables. In case of non-monetary items, they will be your assets and your inventories and your investments. So AS 11 is completed here. We will jump to our next accounting standard. We will jump to AS 12. Then we will jump to AS 15. So in case of AS 12, we will understand AS 12 with the help of a chart. With the help of a chart. I've prepared the chart. So what is AS 12? AS 12 is nothing but your government grant. Government grant. So government grant is bifurcated into two parts. One is capital, one is revenue. Okay. So we will term this as my capital approach. This will be my revenue approach. And this will be further bifurcated into two parts. One is consideration as promoters' contribution, as promoters' contribution, I will consider this as promoters' contribution relating to PP. This will be in my chart A, which we will have a separate chart. We will say add to capital reserve. So what is government grant? What should be the classification? How we will understand whether we should treat it as a revenue receipt or a capital receipt. We will understand this. See, government grant is nothing but a donation which you have received from your government. So we have received something from our government, which is termed as government grant. So first of all, why should government pay us or give us anything? Take an example. See, in any remote area, to develop any remote area, I have told Mr. Tata, please come and open factory here. I will give you free land. Mr. Tata, please open here. I will pay you 25 crores if you will open factory in this remote area. The main reason for government is to promote industry in that remote area. So if you are a businessman and if you have received 25 crores, I'm taking an example of 2 crores, 5, 20 lakhs, 20 lakhs. Take an example of 25 lakhs. Sir, I've received 25 lakhs. What should I do? What should I do of this 25 lakhs? So first we will understand the nature why you have received this 25 lakhs. So first we will understand why you have received this 25 lakhs. Okay. Sir, government has said if you will start company here, we will pay you 25 lakhs. If you will start company here, we will pay you 25 lakhs. But 25 lakhs is to start a company. It is not for a particular asset. If you will purchase this asset, then I will pay you. No. It is to start a particular company in this remote area. So it is just like a capital contribution. So we will add this to a capital reserve. So we will add this to a capital reserve. Example, rupees 25 lakhs received to start a company. So rupees 25 lakhs received to start a company. This is not relating to a particular asset. But if you will start a business, then I will pay you 25 lakh rupees. So this is considered as my capital contribution. This should be added to my capital reserve. Yes. The second one is, if you have received relating to a particular asset, how should we treat it? If you have received the contribution for a particular asset, so PPE, if you have received relating to a particular asset, will be further bifurcated into three parts basically. The first part is the example which I've already given. I will give you free land. Free asset is given. Asset is given for free. Free asset is given. Yeah. I've given you 10 crores ka land for free. I've given you 25 lakhs rupees wala land for free. Sir, I'm so happy for you. So, example is 25 lakhs land received without any consideration, means which is free. Without any consideration, which is free. So that if I have received a land which is costing 25 lakhs for free, what should I record in my balance sheet? So they are saying this should be recorded at nominal value. This should be recorded at nominal value. Nominal value can be rupees 10, 100, 1000. Okay. So I will record this land at rupees 100, which is termed as my nominal value. The second thing is I have received the contribution relating to depreciable assets. And the third one will be non-depreciable assets then. Non-depreciable assets. So the contribution received, first you have received a free asset. The second one is you have received relating to depreciable assets. The third one is you have received relating to non-depreciable assets. So in case of depreciable assets, there will be chart B and this will be chart C. So if I have received for depreciable assets, so take an example. Asset cost is 60 lakhs. Government grant received is 20 lakhs. Life of an asset is 10 years. Of asset is 10 years. Okay. So what should we do now? So you have two methods basically to follow. Method 1 and method 2. The first method is you have received kitna? 20 lakhs. Your asset cost was 60 lakhs. So effectively, the cost of your asset is 40 lakhs only, na Papa? So we will say asset cost is 60 lakhs minus 20 lakhs. Your asset cost is only 40 lakhs, na? You should charge depreciation 40 lakhs divided by 10. You should charge 4 lakhs every year. Khatam. The second method says we can do a second approach. Your asset cost is, sir, 60 lakhs minus 20. No. Your asset cost is 60 lakhs only, na? Asset cost is 60 lakhs only. Your depreciation and your government grant receive is 20 lakhs. So what you should do, this should be debited to P&L. What you should do, your depreciation will be 60 lakhs divided by 10 years, which is 6 lakhs should be debited to P&L. Plus debited to P&L plus you have received 20 lakhs as government grant. This 20 lakhs divided by 10 years, 2 lakhs should be credited to P&L. Means you should debit 6 lakhs and credit 2 lakhs. The net effect is again 4 lakhs only. Net effect is again 4 lakhs only. It is just a presentation given. So either you can say 60 minus 40 on this 40 lakhs, I will charge depreciation, which is for 10 years, 40 lakhs divided by 10, which is 4 lakhs per year. We will debit to profit and loss account. Or you can say, sir, 60 lakhs divided by 10, I will debit my profit and loss account with 6 lakhs and credit my profit and loss account with 2 lakhs. So my effective cost will, in both the cases, will be 4 lakhs only. Sure. And the third part is, if you have received this, if you have received relating to non-depreciable assets. So example, sir, Nikhil, you have purchased a land. You have purchased a land. So land is non-depreciable, sir. I purchased a land for 50 lakhs. And you have received government grant of rupees 10 lakhs. I have received a government grant of rupees 10 lakhs. So they are saying, again, there will be two things. Are there any terms and conditions? Are there any terms and conditions? You have received 10 lakhs. Are there any terms and conditions? Sir, no. There are no terms and conditions. Or we can say, yes, sir, there are terms and conditions. If they transfer to capital reserve or credit your capital reserve account. So if there are certain terms and conditions, treat it as a deferred income. Treat it as a deferred income. Sir, I will summarize it. Don't worry, but just go with me. The thing is, chalo. Sir, what is government grant? Government grant is nothing but an donation received by the government. So there are basically two approaches. One is capital approach, second one is revenue approach. Capital approach means if the nature of the grant is of capital nature. So the first approach is you have received the grant to start your business. So the amount received is like a capital contribution. So it should be credited to your capital reserve account. If the grant is relating to a particular asset, we have further bifurcated that into three parts. If we have received a free asset, if it is relating to depreciable asset, if it is relating to non-depreciable asset. If the asset received is free, the asset should be recorded at nominal value, which is 10 rupees, 1 rupees, 100 rupees. If the asset is depreciable assets, we have bifurcated into two things. Method 1, method 2. If the cost of asset is 60 lakhs and the government grant received is 20 lakhs, what you can do is 60 minus 20, 40 lakhs should be depreciated over 10 years. Or you can do 60 lakhs divided by 10, 6 lakhs should be debited to your profit and loss account, 20 lakhs divided by 10, 2 lakhs should be credited to your profit and loss account. In both the cases, your profit and loss account is debited by 4 lakhs only. In the current case, it is 4 lakhs. In the second case, it is 6 lakhs debit, 2 lakhs credit. The net effect is 4 lakhs only. And the third part is in case of non-depreciable asset. In case of non-depreciable asset, the question which we should ask is, are there any terms and conditions attached? If yes, you should treat it as a deferred income. If no, credit your capital reserve. So what do you mean by deferred income? This 10 lakhs should be deferred. This 10 lakhs should be deferred to your income, to your profit and loss account in proportion to the expense, which you will incur to satisfy that terms and conditions. Okay. Sir, example. Sir, I have given you a land now. Nikhil, I have given you, for this land, I have given you 10 lakh rupees. Okay. Very good. But the terms and condition is the land is full of potholes and so on. The land is full of potholes. So you should repair the land and all. Alright, sir. So this amount, so in the current year I've done only 30% repair, sir. So 10 lakhs into 30% with 3 lakhs should be credited to your profit and loss. Sir, in the second year I have done 50% repairs. So 10 lakh into 50%, 5 lakh should be credited to your profit and loss. Sir, in the third year I have done 20% repairs. So 10 lakhs into 20%, the remaining 2 lakhs should be credited to your profit and loss account. This is a system or the concept of deferred income. And the second one is if the receipt is of revenue in nature. So this will be further bifurcated into. So we will do this as my point D. So there are two approaches in case of revenue. Deduct it from your expense. And the second one is to treat it as a income of more than 1 year, or treat it as a deferred income. The example is keys. So no, please, Nikhil, I will pay you 40 rupees. I will pay you 40 rupees. If you will employ only the local persons, I will pay you 40 rupees if you will employ the local persons. To pay local persons, my salary is, to pay them, their salary is 100 rupees. I have to pay them 100 rupees. If you employ local persons, we will pay you 40 rupees. Very good, sir. So in the first case, the profit and loss account will be reflected as rupees 100 minus rupees 40. Profit and loss account will be debited by rupees 60 only. In the second case, we will credit profit and loss account. We will debit profit and loss account with 100 and credit profit and loss account with 40 rupees. Or we can say that, sir, Nikhil, if you will employ local persons, we will pay you 100 rupees for 3 years. 100 rupees for 3 years. So 100, 100. Or Nikhil, we have paid you 300 rupees. But it is for 3 years. So I will credit my profit and loss account with rupees 100 every year. Government paid rupees 300 for 3 years. So basically, rupees 100 should be credited every year. So this is our accounting standard 2 government grants. This is my accounting standard 2 government grants. So the first one is capital approach. The second one is revenue approach. If the government grant is relating to contribution, if you will start your business, I will pay you. I will invest in your business 25 lakh rupees. So that 25 lakhs, or I will give you 25 lakhs, should be credited to capital reserve account. And the second thing is it is relating to a particular asset. So we should understand type of assets. If the asset is given free of cost, the asset should be recorded at the nominal value, which is 100 rupees or 1000 rupees. If the asset is a depreciable asset, there are two methods. One, you should subtract it from the cost, or other thing is you should credit the government grant and according to the useful life of the asset, which was 60 divided by 10 years, which is 6 lakhs debited, 20 divided by 10 years, 2 lakhs should be credited. And the third one is, if it is a non-depreciable asset, are there any terms and conditions? If the answer is no, it should be transferred to capital reserve account. If the answer is yes, it should be treated as a deferred income. Deferred income means it should be credited to profit and loss account for more than one accounting period. If it is revenue in nature, it should be further, the expenditure should be bifurcated into two parts. It should be either subtracted from the expense and the net expense should be debited to profit and loss account or credited to profit and loss account, net income, or it should be treated as a deferred income. Means I have received an income of 300 rupees for 3 years. So every year, rupees 100 should be credited to my profit and loss account. So accounting standard 11 is done. Accounting standard 12 is also completed now. We will jump to accounting standard 15. Accounting standard 15 is nothing but employees' benefits. So employee benefit means what? Provident fund, pension fund, gratuity, leave encashments, post-retirement health and benefits, and so on. But does not include, please, but does not include extent to the employer's obligation which cannot be reasonably estimated. Yeah, you, Mr. X, you are retiring from a company. You have done an extraordinary job. I am liable to pay you 2 lakh rupees. But since you have done an extraordinary job, I will pay you 6 lakh rupees, 4 lakh rupees extra. This 4 lakh rupees, this is an ad hoc payment. I have given only to Mr. X. I have not given to any other person. Well, of course, Mr. X was good one or bad one, that is a different thing. But this is an ad hoc payment. So this 4 lakhs should not be covered under employees benefit as per AS 15. So AS 15 has bifurcated the plan or the benefit into 2 types. One is defined contribution, defined benefit plan. You should contribute rupees 100 minimum. Khatam. I should contribute rupees 100. That's all. This is my liability. Khatam. I don't have to work. I don't have to think anything else. The second thing is ki, after 10 years, when the employee retires, you should pay him minimum 10,000. In the first case, Nikhil, let it be. You should contribute only 100 rupees. The remaining will be done. You should only contribute rupees 100. That's all. You should not do anything else. Enjoy your life. But 100 should be contributed every year. This is defined contribution plan. Defined benefit means, Nikhil, you should pay at the time of retirement, you should pay minimum 10,000 to the employee. This is known as defined benefit. The early one was known as defined contribution plan. Chalo. Retirement benefit is determined by contribution at the agreed specific rate to the fund together with the earnings thereof. Contribution, whether paid or payable for the reporting period, is charged to profit and loss account. Excess, if any, is treated as prepayment. So, Nikhil, you should pay rupees 100 minimum. So, if I've paid 120, 20 rupees should be considered as prepaid and 100 rupees should be debited to profit and loss account every year. Okay. Chalo. Amount paid is usually determined with reference to employees' earning and or oblique year of services. If the basic of the contribution are determined, it is stated as a defined contribution scheme. However, if it is employer's responsibility is subject to specific benefit or a specific level of benefit, it is defined as benefit of scheme. Means you should pay minimum 10,000 at the time of retirement. So this is defined benefit scheme. Oblique plan. The extent of employer's obligation is largely uncertain and subject to estimate and further conditions and events beyond his controls. Actually, accounting treatment is more important. If no specific fund is prepared, provision for accruing liability is debited to profit and loss account. The provision is based on actuarial assumptions. So actuarial person will say, according to the assumptions and according to the number of employees and number of services and all, you should debit this much amount. So we should debit that much amount to my profit and loss account. Own separate or specific fund established by the trust. Established through trust. The amount required to be contributed on actual basis is certified by the actuary, and the actual contribution plus the shortfall to be met by the actuarial amount is charged to profit and loss account for the accounting period. Any excess payment treated as prepayment. Means, in the second case, I will create a trust for my employees. So the company, say in the first case, company directly pays to the employees at the time of retirement. In the second case, company will create a trust. Company will deposit or transfer the amount to the trust, and at the time of retirement, trust will pay to the employees. So very good. So in this case, any amount contributed to the trust plus any shortfall which you should have contributed but which you have not contributed should be debited to your profit and loss account. In the third case, fund established through insurer. In the third case, it is the most easiest thing. Just like insurance, we are paying to a particular insurer company. The company will pay rupees 3,000 to SBI insurance, and SBI insurance will pay at the time of retirement. So I should pay 3,000 to SBI. That's all, nothing else. And SBI will pay at the time of insurance. In the same manner, the actuarial valuation may be carried out annually or periodically where the actual certificate is required, and the contribution then should be debited to your profit and loss account. Disclosures are, in the view of various practice, educate disclosure of method of accounting for an undertaking of significance of such cost to the employer should be disclosed. Disclosed separation should be made for statutory compliance or otherwise the retirement benefit costs are treated as an element of employees remuneration, because you should disclose few things. I don't think this will be asked in your MCQs pattern. You should not read this thing. Treatment of ERS, no. That's all. So after A is 50, we will jump to a next. These sums are relating to your related parties. These sums are related to related parties, which is accounting standard 18. So please, we will cover the same there. It is just a typo error. AS 18. Sure. So AS 16. Borrowing cost. See, before starting this standard, we will understand what is borrowing cost and what is the normal treatment of borrowing cost here. So what is borrowing cost? Borrowing cost. The cost which is relating to borrowing should be termed as my borrowing cost. Yes, sir. Like interest. Like you have paid any loan fees, processing fees, and so on. It should be debited to profit and loss account. Normally, it should be debited to profit and loss account, but in few cases, the borrowing cost should be capitalized. Okay. Chalo, we will understand that as well. AS 16 deals with accounting for borrowing cost. This statement does not deal with cost of owner's equity, including preference share capital. So they deal with only borrowing cost. So what do you mean by borrowing cost? Interest and bank charges and so on for a short term and long term. Amortization of discount or premium on related borrowing. Sir, debentures are issued at discount or issued at premium. Amortization of ancillary cost, loan processing fees, financial charges in respect of asset acquired under the financial lease, exchange difference arising from the foreign currency borrowing to the extent that they are regarded as adjusted to the interest cost. We will understand the fifth point with the help of a sum. So the first one is interest, another commitment charges. The second one is discount and premium. We will take the example of discount on issue of debentures. The third one is ancillary cost, which is loan processing fees. The fourth one is considered as asset acquired under financial lease. And the last but not the least is in case of foreign exchange loan borrowing. So these 5 costs are considered as borrowing cost. So what is the treatment of borrowing cost? Normally debited to profit and loss account? Yes. But borrowing cost, which is directly relating to acquisition, construction, or production of qualifying asset, should be capitalized. So normally borrowing cost is debited to profit and loss account. But in case of qualifying asset, they should be capitalized. So, sir, what do you mean by qualifying asset then? A qualifying asset, an asset which takes substantial period of time to get ready for its intended use or sale is called as a qualifying asset. See, so first one was normally borrowing cost should be debited to profit and loss account. But in case of qualifying asset, the cost should be capitalized. So what do you mean by qualifying asset? Qualifying asset is an asset which takes substantial period of time to get ready for its intended use. Intended use means it is a fixed asset or for sale or for sale. Intended use means it is an asset, and for sale means it is an inventory, is called as an qualifying asset. So any asset which takes a substantial period of time to get ready for its intended use or sale is known as a qualifying asset. Examples are manufacturing plant, power generation facility, inventories that require substantial period of time to bring them to their saleable conditions. And the last is investment properties. So, sir, what do you mean by substantial period of time then? What do you mean by substantial period of time? So, before understanding all the examples, we will understand. So, what do you mean by substantial period of time? Case wise, it differs from case to case. What constitutes a substantial period of time primarily depends on the facts and circumstances of each case. The time that the asset takes technologically and commercially to get ready for its intended use or sale should be considered in this regards. Okay. So time taken for its intended use or sale means what? The following assets ordinarily take 12 months or more to get ready for their intended use or sale unless contrary is proven by the enterprise. Assets that are constructed or otherwise produced for the entity's own purpose. I'm constructing my office building for my own use. I'm constructing my equipment, my plant and machinery for my own use. Asset constructed under a major capital expansion. Asset intended for sale or lease that are constructed or otherwise produced as a discrete project. Example, shipbuilding and so on. So any asset which takes normally more than 12 months can be termed as an qualifying asset. It is not necessary that you should take 12 months. 12 months is not considered a substantial period of time. 12 months is not considered as substantial period of time. If an asset takes 8 months or 10 months also, still we can call him as an qualifying asset. Still we can call that 10 months as a qualifying as a substantial period of time. But normally, to understand a particular thing, if an asset takes more than 12 months to complete or to construct, we will term them as an qualifying asset because it takes substantial period of time. In case of inventory, see, while reading the definition, it was applicable to asset as well as to inventory. So inventory normally don't takes 12 months of time, sir. It hardly takes 15 days, 20 days, 1 month, 2 months. So we will read this thing as well. Inventories are said to be involved substantial period of time when time is the major factor to bring about the change in the condition. Okay. Example, maturing of liquor for a longer period. So we will take an example of rice, of liquor or cheese. Basmati, 1 से 2 साल पुराना. You have heard this tagline from basmati rice. The older the rice, the more costlier it is. Same goes for wine, same goes for cheese. If the wine is kept for 10 years, for 20 years, it will be more costly. Same goes for cheese as well. So the time is the major factor. Manufacturing is done in 15 days, 20 days. But to sell that product, we have to keep that product for 1 year, 2 years. So time is the major component in this case. So the borrowing cost should be capitalized in case of inventory if inventory takes substantial period of time. We have taken an example of cheese, we have taken an example of rice, we have taken an example of wine. A period of 12 months is considered as a substantial period of time unless a shorter or a longer period can be justified on the basis of fact and circumstances of each cases. So I've told you normal, see, 12 months is not, in case of 10 months also we can say it is a substantial period of time. It is not necessary that 12 months is considered as a substantial period of time. Please keep this thing in mind. Sure. So sir, if an asset takes substantial period of time, it is a qualifying asset. We can say the example of manufacturing of a plant, power generation facilities, inventories which take a substantial period of time like cheese and so on, investment properties, a building and so on. Huh? Exclusion from qualifying assets. Investment properties are the properties which are not used for a business purposes, but they are given on rent. Exclusion from qualifying asset. Asset that are ready for their intended use and sale when acquired. I've purchased a ready-made laptop. So, sir, borrowing cost should not be capitalized. I've purchased a land and we will construct a building, and after 10 years, 12 years, and after 1-2 years, we will receive the building. So that takes a substantial period of time. Then it is a qualifying asset. Since the asset is ready for its intended use, no time is required to prepare that asset. Na? So if an asset is ready for its intended use, it is not considered as a qualifying asset. Inventories that are routinely manufactured. See, inventory takes 10 days, 15 days time. So inventory which are routinely manufactured should not be considered as qualifying asset. Any inventory which take a substantial period of time, 1 year, 2 years, 3 years, should be considered as a qualifying asset. Investments other than investment properties. See, I've told you the example of investment properties. See, I've taken a building, I've constructed a building, and I will use it to earn rent. So we'll consider that building has my investment properties. So any investment other than investment property should not be considered as a qualifying asset. Keep this thing in mind. Exclusion are if it is ready for its intended use, if inventories which does not take a substantial period, they are produced in 10 or 15 days or in their normal operating cycle. And the third one is are the investments other than investment properties. So, terms and conditions for capitalization of cost. Borrowing cost which is directly attributable to the acquisition, construction, or production of qualifying asset are to be capitalized. They are capitalized when it is probable that the result in the future economic benefit of the enterprise and the cost can be measured reliably. Borrowing cost is directly attributable and asset is taken a substantial period of time. First thing, future economic benefit, cost is measurable, directly attributable, asset is taken substantial period of time. If all the four terms and conditions are satisfied, then the cost should be capitalized. First, future economic benefit is received. Second thing is cost can be measured reliably. Third thing is the cost is directly related to that asset only. And the last thing is asset has taken substantial period of time. So how to calculate? Sir, what will be our borrowing cost? Borrowing cost is nothing but the loan amount into rate of interest into period. This will be termed as my borrowing cost. So if the cost is relating to that particular, I have taken a loan of 10 lakhs to buy a car. So the loan is directly or specifically relating to that car. So in that case, any interest paid relating to this 10 lakhs should be capitalized. If you've taken any specific borrowing, means any borrowing is specifically for the purchase of an qualifying asset, it should be capitalized. Okay. So amount to be capitalized is actual borrowing cost incurred during the year less any income on the temporary investment on this borrowing. Means I want to purchase a car. I want to purchase a car of 10 lakh rupees. I've taken a loan from bank of 10 lakhs. Okay. Normally bank will give you 40 or 60% loan. But chalo, take an example of 10 lakhs only. To purchase a 10 lakh car, I have taken a loan of 10 lakh rupees. But the car manufacturer told me, you should wait for 2 months. After 2 months, I will provide you car. And after 2 months only, you can pay me. So the thing is, for 10 lakhs, what should I do of this 10 lakhs for 2 months. I've invested in a fixed deposit of 2 months. And on this 10 lakhs, I've received 2,000, 3,000. And after 2 months, I've given 10 lakhs rupees to the dealer. And for the whole period, I should pay to the bank 40,000. For the whole period, I should pay to the bank 40,000. So your actual cost incurred is 40,000. But for 2 months you have invested, na? So how much did you have made? So 2,000 rupees. 2,000 should be subtracted, and the remaining cost, which is 38,000, should be capitalized. So what do you mean by general borrowing? Sir, I have taken a loan. So we can read it also, sir. Means a range of debenture instruments are used to borrow funds at a various rate, and such borrowing are not really identifiable within specific qualifying assets. Sir, I've taken a debenture. I have issued debentures. Okay. I've issued two type of debentures to buy 4 qualifying assets. But they can't be directly linked, but they can't be specific to that asset also, but they can be directly linked. They are not specific to a particular asset, but they can be linked directly. Means I've taken 10 lakh rupees ka loan. For this 10 lakh rupees, I've purchased a bike, I've purchased a printer, I've purchased a laptop, I've purchased a camera, and so on. So they can be linked, but they are not specific to a particular asset. So these will be termed as journal borrowing. So in case of journal borrowing, you should calculate weighted average cost of borrowing. Weighted average cost of borrowing will be a borrowing cost divided by a total loan amount. So you will get a particular percentage. So the amount of interest which you have paid in that particular year divided by your borrowing, divided by your total borrowing, you will get on an average rate. So see, I have taken debentures at the rate of 10%. I have taken loan at the rate of 14%. I have taken another loan at the rate of 18%. So I will calculate 10%. I will calculate interest on debentures, interest on term loan A, interest on term loan B. The total interest should be divided by the total borrowing cost. So the net percentage will be my weighted average cost of borrowing. So weighted average cost of borrowing should be used to calculate your borrowing cost, and that borrowing cost should be capitalized. So commencing of capitalization of borrowing cost. When should the borrowing cost capitalization should be started or commenced? Activities which are essential to prepare the asset for its intended use are in progress. Borrowing cost is incurred. Expenditure for acquisition, construction, or production of the qualifying asset is being incurred. 3 things. You see, we will take an example of the building. To construct a building, I have bought some bricks, some cement, and so on. Also, the laborers are working for the foundation. And the third thing is I've also taken the loan. So I've purchased. The thing is I've purchased the material on 1st of April. I've purchased a material on 1st of April. The loan was taken on 1st of February. And the activities relating to the same were started on 1st of June. So the start date will be 1st of June. Start date will be 1st of June. See, in case of 1st of February, only second point is only the borrowing cost is incurred. But there was not any activity nor any expenditure which we have incurred on my qualifying asset. In case of 1st of April, borrowing cost is incurred, yes. Expenditure is done, yes. But is there any activity relating to the asset? So not yet. So this date should also not be considered as a start date for capitalization. On 1st of June, I've incurred my expenditure, yes. I've incurred my borrowing cost, yes. And the manpower is working on the asset for its present condition and for its intended use, yes. If 1, 2, 3, all the 3 conditions are satisfied on 1st of June, so 1st of June should be your effective date for capitalization. Sir, in process means direct activities relating to physical construction, supporting activities like technical, administrative, blueprint of the building and so on. Activities during which the asset is merely held and when no production or no development take place will not be treated as a progress. So there should be a start date, there should be an end date. See, in case of loan and all, following thing will be that there will be a start date, there will be an end date, there should be an asset, there should be rate of interest, there should be a loan. So loan is general and specific. Rate of interest is weighted average, or in case of specific, we can calculate normally. Asset is an qualifying asset. Start date is the date of commencement. There will be suspension and then there will be an end date. So, sir, what will be suspension? And the last one will be the end date or the cessation of borrowing cost. Suspension means what? Suspension of a capitalization of borrowing cost. Capitalization of borrowing cost should be suspended during the extended period in which activity for development is interrupted. That means, sir, they have started building, they have started construction for 2-3 on 1st of June. After 2 months, they said, "Ki sir, we are not in the mood to construct now. We will construct after 1.5 months." What is this, man? Yes, sir. We will not construct now. We will construct 1.5 months. For 1.5 months, there was no activity. So for this 1.5 months, capitalization of borrowing costs should be ceased or stopped or suspended. Following are the exception to this. During the period when substantial technical or administrative work is being carried out, when a temporary delay is necessary for the part of process of getting an asset for its intended use. So the first, what is the first thing and the second? Sir, after 3 months, July, August, September. After September, they said, sir, after 3 months, we will need an engineer to develop a particular plan for further processing. An engineer of 1 month for the planning, approval, and for the planning and so on. So in that case, capitalization should not be suspended. The second, after 3 months, they told me, sir, we will require 20 to 30 days for the foundation to stabilize. For 30 days, the foundation will require 30 days to stabilize. After 30 days only, we can start our construction. So in such a case, suspension should not, there should not be any suspension of borrowing cost. The following are the 2 exceptions. What are the 2 exceptions? Substantial technical and administrative work or temporary delays necessary or the part of process. So then it is not an issue. In these 2 cases, you can carry on with your work. Just give me a second. So, last one is your end date or your cessation date. Cessation of capitalization of borrowing cost. Capitalization of borrowing cost should be ceased when substantially all the activities necessary to prepare the qualifying asset for its intended uses or sale is completed. Sir, my building is completed. Completed, sir. After completion of building, you should not capitalize the cost. Capitalization of the borrowing cost should be ceased, means stopped, when substantially all the activities necessary to prepare the qualifying asset for its intended use or sale is completed. All the relevant activities which are essential for its intended use or sale of qualifying assets should be completed, even though routine administrative work might still continue. Construction of an qualifying asset is carried in a part or a phase manner. See, I want to construct 3 buildings. Building A, Building B, Building C. Building A is fully completed. Building C, B and C are still in progress. So borrowing costs relating to building A should be seized. But in case of B and C, still should be capitalized. Carrying in part or phase, each part or phase can be termed as an independent unit, and for each part there should be a start date and there should be an end date. And the last one is 11th one, borrowing cost on account of foreign currency exchange. AS 16 borrowing cost provides that borrowing cost may be included in exchange differences arising from foreign currency borrowing to the extent that they are regarded as adjusted to the interest cost. So what do you mean by this? We will understand that with an example or with a sum. Example is, so particulars, foreign loan, Indian. See, Mr. A has taken a loan of $1,000 at the rate 2%. Mr. A has taken a loan of $1,000 at the rate 2%. So chalo, the amount of expenditure in case of foreign loan is, so the loan amount is चलो नहीं तो डॉलर में the loan amount is 1,000. If we convert that into dollars, it will be $1,000 into 50 rupees. The loan was taken on 1st of April 2016, which is 50 rupees. So $1,000 into 50 rupees is 50,000. The loan amount taken is 50,000. Interest is at the rate of 2%. So 1,000 into 2% comes to, so $20 only. Very good. So if we convert that into Indian rupees, so I will say foreign loan. So if we convert that amount into Indian rupees, so 20 into 60 is 1,200. It is $1,000 into rupees 50, and it will be $20 into rupees 60. See, interest is payable on the last date, which is 31st of March 2016. On 31st of March 2016, the exchange rate is 60. On 1st of April 2016, the exchange rate is 50. So on 31st of March, interest payable is $20. $20 into rate is 60 rupees. Also, we have to repay the loan. So you should repay how much? Sir, $1,000 only, na? You should repay how much? $1,000 only. See, I've taken a loan of $1,000, so I will repay $1,000 only, and I pay $20 as the interest also. But at the time of repayment, the exchange rate is 60 rupees. So my exchange rate is 60 rupees. Means if we convert this 1,000 into Indian rupees, I have paid 60,000. So in case of dollars, I've taken $1,000 loan, I have repaid $1,000. So there is no effect. But in case of when we convert the same into Indian rupees, I have a loss on foreign exchange of 50, 60 minus 10. We have a foreign exchange loss of 10,000, and we have paid an interest of 1,200. So the total expenditure which we have incurred because of foreign loan is, total expenditure because of foreign loan is 10,000 loss plus 1,200 rupees interest. So total expenditure because of foreign loan is 11,200 rupees. If the same loan was taken from Indian bank, loan taken from India or from Indian bank, what would have been my situation? Loan amount is $50,000. See, this will be in Indian rupees only because bank will pay you in Indian rupees only, 50,000, and the interest rate in India is 10%. So $50,000 into 10% will be 5,000. So the total expenditure if the loan was taken in India is only 5,000. There will be no exchange loss or gain. So if you're taking the loan from an Indian bank, you will get 50,000. You will get a loan of 50,000 in Indian rupees. You have to pay in Indian rupees also. So there will be no repayment. There will be no foreign exchange because you are taking and paying in the same currency. The only expenditure is of interest, which is 5,000 rupees. But if you're taking your loan in foreign currency, your total expenditure is your interest cost as well as your foreign exchange difference. As well as my foreign exchange difference is my total expenditure. So my total expenditure is 11,200. So as per accounting standard 16, they bifurcate this 10,000, this 11,200 into two parts. They say, Nikhil, 5,000 should be considered as borrowing cost, and the remaining, which is 11,200 minus 5,000, which is 6,200, should be considered as your forex loss. Okay. So, sir, we are not considering 1,200 as my borrowing cost and 10,000 as my foreign exchange expenditure. We will consider out of this 11,200, we will consider 5,000 as my borrowing cost. See, because if you have applied your loan in Indian bank, still you have to pay 5,000 rupees. So minimum 5,000 should be considered as your borrowing cost. So out of 11,200, 5,000 will be considered as your borrowing cost, and any excess amount should be treated as your foreign exchange loss. So, sir, if we take an example 2, where my total expenditure on foreign loan is rupees 4,000, and my expenditure on Indian loan is rupees 5,000. If I would have taken the loan from India, it would have been 5,000. So what should we do in this case? In this case, say your total expenditure is 4,000 only. 5,000 is your opportunity cost. If you would have taken loan in India, what would have been your cost? So this is your imaginary number. This amount is not incurred by you. You have incurred only 4,000. So the 4,000 will be considered as your borrowing cost. The whole 4,000 will be considered as your borrowing cost. So the limit of borrowing cost is up to the amount of expenditure which you have incurred if you have taken loan from Indian banks. So if my expenditure is above 5,000, the excess amount will be termed as foreign exchange loss. If my borrowing cost or my total amount of borrowing cost is below 5,000, the whole amount should be considered as your borrowing cost. So, disclosure is accounting policy adopted, borrowing cost capitalized. Accounting policy adopted for borrowing cost and the borrowing cost capitalized in case of your qualifying assets. So, the sum is very easy. We should understand whether the asset is a qualifying asset or not. Construction of a shed. Sir, is the asset ready for its intended use? No. Sir, we should qualify. We should say this is in my qualifying asset because it normally takes a substantial period of time. Purchase of machinery. Purchase of machinery is normally. Purchase of machinery, does it take normally substantial period of time for its intended use? No. So it will take hardly 1 or 2 days for its installation. That's all. So this is not termed as a qualifying asset, not a qualifying asset. The third part, working capital is not considered as a qualifying asset. Advance for purchase of truck. Advance for purchase of truck is truck considered as a qualifying asset? No, sir. Truck is not considered as a qualifying asset. So not a qualifying asset, not a qualifying asset, not a qualifying asset. So the loan taken, the interest paid is 9 lakh rupees. The loan taken is 50 lakhs. 50 lakhs is bifurcated into 20 plus 10 is 30 plus 15 is 45 plus 5 is 50. The total amount is 50 lakh rupees. Loan taken is 50 lakhs and 50 lakhs is used for construction of shared machinery working capital and advance for purchase of truck. And for this 50 lakhs, I have paid 9 lakh rupees. So the only interest cost relating to qualifying assets should be capitalized and the remaining should be debited to profit and loss account. So the rate of interest should be 9 divided by 50 lakhs. 9 lakhs divided by 50 lakhs. The rate of interest will be, so we can say nine divided by 50. Rate of interest is 18%. So the cost incurred on construction of shed is 20 lakhs. So 20 lakhs into 18% will be 3.6 lakhs. So we can say that out of 9 lakhs, 3.6 lakhs, which is relating to qualifying assets, should be capitalized. And the remaining amount, which should be 5.6, yes, 5.4 lakhs should be debited to profit and loss account because it is not relating to any qualifying asset. So after 16, we should jump to our next accounting standard, which is segment reporting, AS 17. So what do you mean by a business segment and a geographical segment? So we will take an example of Reliance. What kind of service do Reliance provide us? So Geo. And petrol. Reliance Retail, Reliance Digital, Reliance Entertainment, sir. So Reliance is in many fields. So Reliance is in many fields, in many businesses. So each such business is different from the other one. So telecom is different business, petroleum is different business, entertainment is different business, retail is a different business. Each business has their different risks and opportunities. So each such different business will be termed as a business segment. We will read this now. A business segment is distinguishable component of an enterprise that is engaged in providing individual product or services, group of product or services, and is subject to risk and returns that are different from those of other businesses. Say in case of petroleum, the competitor is different. In case of telecommunication, the competitor is different. In case of retail, the competitor is different. So in case of telecommunication, the competitor is Vodafone Idea, Bharti Airtel. In case of retail, the competitor is DMart. They have purchased Future. They had purchased Future, which is known Big Bazaar, the owner of Big Bazaar. But there will be other retail players like H&M, Spencer's, Shoppers Stop, and so on. So for every business, there will be different competitors. There will be different risks and returns. So each such business can be termed as a business segment. We will take a second example of Coca-Cola. So Coca-Cola is in India, in the US, in UK, in Canada, in Russia, and so on. So in India, they will face different challenges. In US, they will face different challenges. In UK, they will face different challenges. And Canada different, and Russia different. So each area is different from another. Each area have their different risk. So they are termed as geographical segments. So Coca-Cola is providing almost same products in every country, but the risk is different. The risk is different, na? A geographical segment is distinguished component of an enterprise that is engaged in providing product or services with a particular economic environment, and it is subject to risk and different that are different from those components operating in other economic environments. There will be different risk in Russia, there will be different risk in US, UK, and so on. So what is a reportable segment?
A reportable segment is a business segment. Is a business segment or a geographical segment identified on the basis of foregoing definition for which the segment information is required to be disclosed as per by this statement as per point 9. So what is reportable segment? A business segment or a geographical segment is termed as a reportable segment, which satisfies the conditions as per point 9, which we will understand now. So sir, what is segment revenue? What is segment revenue? Segment revenue means, see, we will take an example of Reliance. Reliance is in Geo and oil and retail and many more. But we will take an example of 3 only. So Reliance Geo, Reliance Oil and Reliance Retail. So Reliance is in these 3 segments. So these 3 will be termed as their business segments. So normally Reliance should present a profit and loss for all the 3 segments combined. But Reliance should also represent profit and loss account for Geo, profit and loss account for retail, profit and loss account for oil as well. As per which accounting standard? As per accounting standard 70. So for Geo, what is their revenue? For oil, what will be the revenue? And for retail, what will be the revenue? So segment revenue is an aggregation, means total of directly attributable to that segment. The Geo has a plan of 129, 229 and so on. So that is directly relating to that segment, allocated on reasonable basis to the segment. So this is the revenue commonly earned by Reliance Geo, oil and retail. So which can be allocated commonly. 40% is because of Geo, 20% is because of oil, and the remaining 40% is because of retail. The one which is directly attributable to the segment, which is relating to the Geo, which is earned commonly but can be attributable or distributed between the 3. And the third thing is Reliance Jio has given his telecom services to Reliance Retail as well as to Reliance Oil. Directly attributable to the segment, allocated on the reasonable basis, transaction with the other segments of the enterprise, which is oil and retail. So these 3 things should be included in their revenue. The things which should not be included are extraordinary items, interest and dividend income, gain or loss on sale of investment. Interest and dividend income should be included if your primary business is of financial nature. Otherwise, interest and dividend should not be included in the segment report. What the segment expenditure say? Directly attributable to the segment, allocated on reasonable basis, include expenses relating to transaction with the other segments. So Geo has given me the service. So for Geo, it will be revenue, and for Reliance Retail and for Reliance Oil, it will be the expenditure. Okay? And not to be included extraordinary item, interest and dividend expenses, unless otherwise you are a financial, unless otherwise your primary business of a financial nature. Losses on sale of investment, income tax expenditure, general administrative expenditure, head office expenditure, and other expenses that are at the enterprise level and related to the enterprise as a whole. Like Mukesh Ambani, we are paying Mukesh Ambani Reliance is paying Mukesh Ambani a salary of 15 crores. 15 crores cannot be allocated between Geo, retail and oil. Na? So please, you should not treat them as the total expenditure. They should not be treated as the segment expenditure. So segment and revenue we have understood, segment expenditure we have understood. Segment result is nothing but profit. Is segment revenue minus segment expenditure. Segment assets employed by the segment in its operating activity and that either are directly attributed or can be allocated to the segment on reasonable basis. That's all. The same point which we've read in income as well as in case of expenditure. Segment liability, same thing. Directly attributable, allocated on reasonable basis. The most important part is reportable segments. So every segment should be reported. Reliance has 150 segments. Every segment should be reported. Kya? No, sir. Only reportable segments should be reported. If any segment satisfies any of the following conditions, it should be termed as a reportable segment. If he is not satisfying one, if he is satisfying one, he is a reportable segment. If he is not satisfying one, but if he is satisfying two, it will be termed as a reportable segment. If he is not satisfying one nor two, but if he is satisfying three, then it can be termed as a reportable segment. This is what is a reportable segment. A business segment or a geographical segment should be identified as a reportable segment if its revenue from sale to external customers and from transaction with the other segments is 10%. Is 10% means minimum 10% or more than the total revenue. So if we say the total revenue is 100 and Geo's revenue is 6 rupees, oil's revenue is 44 rupees, retail revenue is 50 rupees. So as per condition 1, this is 50%, this is 44%, this is 6%. So as per condition 1, this is a reportable segment, this is a reportable segment. This is not a reportable segment. The second one is its segment results whether profit or loss is 10% or more. The combined results of all the profit or the combined results of all the loss. Means, see, Reliance, we will take an example of some other company who have 5 segments. We will take segment 1, segment 2, segment 3, segment 4, segment 5, segment 6. Segment 1 has a profit of 10, segment 2 has a profit of 20, segment 3 has a profit of 40. Segment 4 has a loss of 5, segment 5 has a loss of 6, segment 6 has a loss of 7. So in this case, how should we calculate 10%? Because the total of all this will be 40 plus 20, 60, 70, 70. We will consider this minus 4. So 10, 15 minus 70 minus 15 will be 55. So that total profit is 55. So sir, how should we calculate 10%? So in this case, the total is 55. In this case, we will calculate the total of 1, 2, 3, which is 10, 20, 30. The total of 1, 2, 3 will be, the total of 1, 2, 3 is 70. And the total of 5 minus 5 minus 6 minus 4 is 15. So we will calculate 10 divided by 70, 20 divided by 70, 40 divided by 70. It will be 10 divided by 70, 20 divided by 70, 40 divided by 70. And in case of losses, it will be 5 divided by 15, 6 divided by 15, 4 divided by 15. If it is more than 10%, it will be a reportable segments. And the third is if segment assets are more than 10% of the total segments. So in all these 3 cases, they will be my reportable segments. So first is 10% of revenue, second is 10% of profit or 10% of loss, and the third one is 10% of assets. And the last point is if the total external revenue attributable to the reportable segments consists less than 75% of the total enterprise revenue, additional segments should be identified as reportable segments even if they does not meet the criteria of 10%. Means if total of all the reportable segments, if total revenue of all the reportable segments is less than 75%, you should identify new segments, or you should include new segments even if they are not satisfying any of the above 3 conditions till we have reached the limit of 75%. Agreed? These are few disclosure requirements which are very easy. So we will jump to our next accounting standard now, which is accounting standard 18, which is our related parties. So what is the definition of related parties? So, a related party is essentially any party that controls or can significantly influence the management or operational policies of the company during the reporting period. Controls. Controls means if I will say A, so the answer will be A only. If I will say B, the answer will be B only. Means your timing is 9 to 6, your timing is 9 to 6 only. I control the time. The second thing is I can significantly influence the timing. Means I cannot control the timing, but because of my decision, the timing, the tenure can be influenced. This is the difference between control and influence. The simple example will be your parents will say, do CMA. This is a control. If another teacher approaches and give you an advice that CMA is a good course, this is a significant influence. If they have a significant influence, take the example of your girlfriend or boyfriend. Sir, my girlfriend or my boyfriend told me to do CMA course. This is considered as a significant influence. It will not be considered as a control yet. But in case of parents, do CMA only. So it will be considered as your control. Sorry. So what do you mean by AS 18 deals only with the following relationship? I've taken this with an example. AS 18 deals with the following relationship. Enterprise that is directly or indirectly through one or more enterprise controlled or are controlled by or under the common control with the reporting enterprise. C. A controls B. So this is known as a direct control. B controls C. So means A indirectly controls C also. A controls B directly. Means A controls B. Or indirectly. A controls C via Mr. B. Through one or more subsidiary. Means A control B, B controls C. So means A indirectly controls C. Or are controlled by means A is B and C is controlled by A, are under common control with the reporting enterprise. Or controlled by means C is controlled by B, B is controlled by A, and C is controlled by A indirectly. So in this case, in case of C, B and A both will be the related parties. B and C both will be the related parties. Are common control. A and B are under common control of A with the reporting enterprise. So in these cases, they will be termed as related parties. The second one is relating to significant influence. The first one was control. The second one is relating to significant influence. Directly control, A controls B. Direct. B is controlled by C and means A indirectly controls C. So indirectly controlled by him through one or more or with subsidiary. C is related parties, B is related parties A, and are under common control of the holding means A and C are under the common control of A. The second part is are associated and joint ventures of the reporting enterprise and the investment party or the venture in respect of which the reporting enterprise is associate or joint venture. Means A Limited, subsidiary A Limited associated is B Limited is associate company of A Limited and C Limited is joint venture of A Limited. So in this case, B and C both will be related parties of A Limited. Associate and joint ventures of the reporting enterprise means A Limited and the investment parties or ventures in respect of which reporting enterprise is associate or joint venture. So in case of A, B Limited will be related party and C Limited will be related party. In case of B, A will be related party only. In case of C, A will be related party only. And the third case is individual owning. Individual has control or significant influence in the reporting enterprise. Individual has control or significant influence in the reporting enterprise, then that individual is termed as a related party. Plus, the relative of that individual will also be termed as a related party. Individual owning directly or indirectly an interest in the voting power of the reporting enterprise that give him control or significant influence over the enterprise and relative of such individuals. Relative means spouse, son, daughter, brother, sister, father, and mother, who may be expected to influence or be influenced by that individual in his or her dealing with the reporting enterprise. The last one is key managerial person and their relatives of such person and those person who have authority and responsibility in planning, directing, controlling the activities of the reporting enterprise and enterprise over which individual or key managerial person described as above is able to exercise significant control. So any person who can control the activity of the enterprise or influence the activity of the enterprise is known as key managerial person, and it should be termed as a related party. So the first one is control. If you are controlled, then you are a related party. Control can be direct and indirect. In both the cases, all the parties will be termed as they are related parties. The second thing is if they are associate or joint venture, then they are related parties. The third thing is if an individual controls or has a significant influence, then he is a related party as well as his relatives are also his related party. The fourth is key managerial person and their relatives are termed as related parties. KMP means who have control or have significant influence. Classification and disclosure. We will jump to the disclosure directly. Disclosure means related party relationship should be disclosed. Transaction between the reporting enterprise and its related party should be disclosed. Means whether he is my holding, subsidiary, associate, joint venture should be disclosed. Also, any purchase, sale, or any kind of transaction should also be disclosed. So, we will jump to our last accounting standard, which is accounting standard 19, lease accounting for. So, we will understand basically what do you mean by lease. Lessor and lessee. Lessor is nothing but your tenant. Lessee is nothing but lessor is nothing but your landlord. Lessee is nothing but your tenant. Type of lease are operating lease and financial lease. What is operating lease? It is a lease which does not transfer substantially all the risk and loss. We will take an example of a phone. See, I have a phone. The life of the phone is of 10 years. The life of the phone is 10 years. For 4 years, I have given this phone to my brother to use or on lease. So out of 10 years, only 4 years I have given. Still, I will enjoy the remaining 6 years. So that lease is termed as an operating lease. The life of the phone is 10 years. I have given to my brother for 10 years on lease. So this is termed as a financial lease. So what is financial lease? The lease in which transfers substantially all the risk and rewards incidental to the ownership of the asset by the lessor to the lessee, but not the legal owner. Legally, I am the owner, but it is used by my brother only for the 10 years. The life of the asset is 10 years. For 10 years only, he is going to use. So even though legally I am the owner, on papers I am the owner, but if you will remove the legal part, my brother is the actual owner of the asset. So that is termed as a financial lease. If I am the legal owner and I am the actual owner, it is termed as an operating lease. If I am the legal owner, but the actual owner is my brother, then it will be termed as a financial lease. we will jump to some important points. Guaranteed residual value. See, residual value is nothing but scrap value. Guarantee. I'm giving guarantee. Guaranteed residual value. See, the asset is of lessor. Asset is not of me. Asset is of lessor. Guaranteed residual value. Such part of the residual value which is guaranteed by or on behalf of lessee or by an independent third party. See, I have given this mobile to my brother for 10 years. Now, after 10 years, my brother is saying, after 4 years or after 10 years, assume, after 10 years, my brother is saying, Nikhil, I will pay you 10,000 rupees. Minimum, I will pay you 10,000 rupees. So this is the guaranteed amount, which is given by the lessee. Also, I go to the Apple store and they told me, Nikhil, we will pay you minimum 7,000 after 10 years. So this is the guaranteed residual value given by the third party. In case of lessee, such part of residual value which is guaranteed by or on behalf of the lessee, which is my brother, which was 10,000 rupees. Unguaranteed residual value. The difference between the residual value of the asset and its guaranteed residual value is known as unrestricted. For this phone, I will receive 15,000, but they have given me a guarantee of 10,000 only. The extra 5,000 will be termed as unguaranteed residual value. Agreed? So, sir, what do you mean by gross investments? Gross investment is sum of minimum lease payment from the point of view of lessor plus any unguaranteed residual value accruing to the lessor. Please understand these terms. They will be used in future. Don't worry. Interest rate implicit in the lease. Discounting rate at which the fair value of the lease is measured. What is this? Fair value of the lease asset. Fair value of the lease asset is present value. Present value of minimum lease payment in respect of lessor at the inception of lease plus any unguaranteed residual value accruing to the lessor. So what do you mean by minimum lease payment? So what do you mean by fair value of the lease payment? What do you mean by interest rate implicit? So first we will go and understand what do you mean by minimum lease payment. From the point of view of lessor, is the total lease rent receivable? Yes. Plus any guaranteed residual value on behalf of lessee plus any guaranteed residual value to be received on behalf of third party. All these three things will be termed as minimum lease payment. So what do you mean by gross investment? So gross investment is minimum lease payment, which is total rent receivable plus guaranteed residual value. Minimum lease payment is nothing but total rent plus guaranteed residual value plus unguaranteed residual value. So gross investment is total rent receivable plus guaranteed residual value plus unguaranteed residual value. In simple words, if I'm giving my asset for 10 years, the total amount receivable is how much, sir? My brother is saying, I will pay you 5,000 for 5,000 every year for the next 10 years. So the total amount which I will receive is 50,000 plus he has guaranteed me 10,000 rupees. And iPhone store has guaranteed me 7,000. So I will go with my brother only, which is 10,000. So 50,000 plus 10,000 plus the unguaranteed residual value, which was 15,000 minus 10,000, 5,000. So total it will be 50,000, 5,000 into 10 years, which is 50,000 plus 10,000, which is guaranteed by my brother, which is 50,000 plus 10 plus 5,000, which was unguaranteed amount. Total is 65,000. So total 65,000 will be termed as gross investments. So what do you mean by the fair value of the asset? Fair value of the asset is present value. How you will find the present value? By using interest rate, which is the discounting rate to measure the asset. You will use the interest rate to calculate the present value of minimum lease period plus any unguaranteed residual value arising from the lessor. So in simple words, it's the present value of gross investments. Because the 5,000 I will receive in first year, second year, third year, fourth year. We will compute their present value. Okay. So, sir, what do you mean by contingent rent? So, the rent which is not fixed is known as contingent rent. It is on particular sale. If you will do sales of 10 lakh rupees, I will receive 1%, 2%, 5%. This is known as contingent rent. Lease rent is not fixed, but it is based on a factor other than time, like on sales, on customer votes, or something else. So, in case of minimum lease period, from the point of view of lessor, total lease rent is included, guaranteed residual values included from the lessee, from the third party, contingent rent is not included, any amount collected for the purpose of tax is not included. Example, I have collected GST of 10,000 also. I have collected GST, goods and service tax of 10,000 also. This 10,000 should not be included into ML and should not be included in minimum lease period. From the point of view of lessee, it will be only total lease rent and guarantee from the lessee. See, the third party has given guarantee to the lessor. So that should not be included in lessee's MLP. So these three things should not be included in lessee's MLP. So, sir, what should be the accounting respectively? In case of lessor, in case of operating lease, I've given this phone for 4 years. So I will assume the cost of the phone is 50,000 rupees. I have given him for 4 years. The rent which I am going to receive is 5,000 rupees. So what I will do, 10 years, assuming straight line basis, 50,000 divided by 10 years, 5,000 will be my depreciation. So 5,000 should be debited to my profit and loss account, and 5,000 rupees rent collected from my brother should be credited to my profit and loss account. This is a simple treatment in case of lessor. In case of lessee, 5,000 should be debited to their profit and loss account. So asset should be fixed. See, lease record leased out asset has the fixed asset in the balance sheet. So fixed assets should be in your balance sheet. Charge depreciation. Recognize lease income to your profit and loss account. Any other expense should be charged to profit and loss account directly. In case of lessee, it should be debited to your profit and loss account. That's all. But in case of financial lease, see, on paper, on legal context, I am the owner, but the actual owner is my brother. I am not the actual owner of the property. So in such a case, in case of lessor, leased asset as well as liability for lease should be recognized at the lower of. Leased asset as well as liability for lease should be recognized at the lower of fair value of the lease asset at the time of inception or the present value of minimum lease payment from the lessee's point of view. So, in case of lessor, it should be recorded at the lessee fair value of the asset or the present value of MLP from the lessee's point of view. Apportionment of the lease payment. See, when you receive, basically the thing is, I have purchased this 50,000. I have given it to my brother, and my brother is paying me. So if you see legally, I am the owner, and if you remove the legal barrier, my brother is the actual owner, and I'm just the financer. I'm just the what I can say. I'm just the loan provider or the financial for him. So in such a case, any amount received from my brother should be bifurcated into two parts. One is relating to the principal amount, and the second one is relating to the interest amount. Apportionment of the lease payment. Each lease payment is apportioned between the financial charges and the principal amount, which is interest amount and the principal amount. I will receive interest. The lessee in the book should charge depreciation on the financial lease as per AS 6. Initial direct cost for the lease asset is included in the asset under the lease. Sorry, my bad. This is lessee. This is lessor. In case of the lessor should recognize asset given under the financial lease as receivable at the amount equal to the net investment in the lease. Net investment is gross investment less unearned financial income. Gross investment is nothing but your minimum lease land from the lessor's point of view plus unguaranteed residual value. Unearned financial income is nothing but your gross investment less present value of gross investment. Agreed? So these are the ways in which you should recognize your financial lease. Chalo, we can conclude now, and from tomorrow onwards we will start our revision of audit. Chalo, thank you so much. Bye bye. Manjari sir, may I conclude?
Yes, sir. Yes. Thank you. Thank you, sir.
Okay. Thank you, sir.
See you tomorrow.
Yeah, same here.